understand the instructions. If you have any questions, let me know. Again, it's really straightforward, no surprises. And then you all will have the flexibility to take the exam any time during the exam period. I think it runs May 4th to May 14th. Any 8-hour period, you can take that at your leisure. And then I'll be around, at least virtually, to answer questions through email or phone calls or Zoom calls, however you want. If as you go through your studying, you want to go over some stuff. So that's the game plan. Any questions about the rest of the course, the exam? Okay, well, hearing none. So I thought I'd just go through, and we're going to stop a little bit early today and give you time to do the teaching evaluations. So that's going to be on your My Georgia Law account. So I encourage you to use the time that I give you to do those evaluations. So let's just start from the top. And I just made a list of sort of the issues that we went over. And we can, mostly we're going to go chronologically how we went in class, but we can reorder a little bit. You can sort of see the non-linearity of this class. So it won't go exactly chronologically, but we started with, formation of the partnership, and that's contributions of property to the partnership. And we know under section 721 and 722 and 723 that combined, those say that no gain or loss is recognized by anyone on contributions of property to the partnership, and then the built-in gain or loss in the asset is preserved in the partnership's carryover basis and in the partner's basis, outside basis. Really straightforward stuff, right? What gets tricky, as we'll see, is that then is going to result in 704C issues when you have contributions of property that have a fair market value different than their basis. Then that becomes what we call 704C property. And then we're going to have to deal with that disparity, and we'll talk about that later on. In the course of that discussion, by the way, just stop me if anybody has any questions. I mean, I know I'm going to go fast through this. I know you all haven't really probably focused yet on your comprehensive review, so this may be a little premature. It might be better to listen to it after you've done a lot of the studying, but this is where we are. We then also started talking about the accounts that we're going to keep track of, and we get capital accounts and outside basis. And we're referring to capital accounts here, we'll refer to book capital accounts. Again, if you hear the word capital account without a modifier, it's going to be, that's referring to book capital accounts. And then we have our outside basis, which is another account that we keep track of at the partner level. And what are the capital account rules? Well, they exist in the regs. 1.704-1B2 4 little i's is our capital account maintenance rules. I think it's actually titled capital account maintenance rules or something like that. And we have basic rules that we went over that are pretty straightforward, and other rules that we circled back to later on throughout the course. And again, one thing to keep straight there is the treatment of partnership debt, right? That your share of partnership debt doesn't get included in your capital account. We talked about that, but again, that's just sort of common pitfalls that students will make, is they will get that rule wrong. And that's in -1B2 4 C, talks about partnership debt and the effect on capital accounts. So those are our capital account rules. And then we've got our outside basis rules. And the outside basis rules are found in section 705 of the code. And in many situations, well, not in many situations, but often the adjustments are the same. So if you get allocated income, your capital account goes up by the amount of income, your outside basis goes up by the amount of income. But sometimes they're different. Your capital account goes up by the fair market value of property you contribute. Your outside basis goes up by the basis of the property you contribute. Your outside basis can't go below zero. Your capital accounts may be able to go below zero. Your outside basis includes your share of partnership debt under section 752. 752 is an important provision. We covered a lot of 752. 752 says when your share of partnership debt goes up, it's a deemed contribution of money for tax purposes. So that means your outside basis goes up by the amount of that deemed money being contributed. When your share of partnership debt goes down, that's a deemed distribution of money. It means that your outside basis will go down and or you might have gain. We'll talk about distributions later on. But that share of partnership debt going up and going down and the effect on outside basis doesn't have an effect on capital account. That's what I just referred to before. So again, that rule 1.704-1B2 4i talks about that. So back in 752, this is where we can change the chronology. We didn't really talk much detail about 752 early in the course. We came back to it later on, but now we know that the question of what's your share of partnership debt, how do you determine your share of partnership debt? Well, now we know that there is what the procedure is. We know the regs 1.752-2 and 1.72-3 tell us how we apportion debt among the partners. And in general, we do that economic risk of loss analysis, the sort of the atom bomb scenario we talked about, and determine whether any partner has to pay the debt in that doomsday scenario. To the extent a partner has to pay the debt, they get that share of the debt. To the extent no partner bears a risk of loss, then the debt is non-recourse, and it gets apportioned under 1.72-3. We have our three-tier structure for apportioning non-recourse debt. And then that all leads into a fact pattern that's very common. I wouldn't be surprised to see it on the exam. I haven't written the exam, so is contributions of encumbered property. We covered that quite a bit in multiple different parts of the course early on and then later on. It's a very common fact pattern where people contribute property that's subject to a debt. And it involves several steps. And we talked about this, that, you have contribution of property that's going to trigger, the 721 and 722 and 723, no gain or loss, carryover basis, so on and so forth. But you also have the contributing partner shedding individual liabilities, because the liability that's secured by the property is coming off the contributing partner's books. So that shedding of individual liabilities is going to reduce outside basis under 752B. It's going to reduce capital accounts because that's not a partner share partnership debt. That's an individual shedding their own liabilities. So that's going to come off the contributing partner's books. But then the partnership now has liabilities it didn't have before. This is a new debt from the partnership's perspective. The partnership assumed the debt. So now that debt is going to be apportioned among the partners under the 752 analysis. The regs I just mentioned, -2, 1.72-2, maybe -3. To sum all that debt may come back to that contributing partner. And often what's going to happen is it's not going to all come back to the contributing partner. Only a portion of it's going to come back to the contributing partner. And if only a portion comes back, then there's a net distribution of money, right? we have a distribution of money equal to the entire amount of liability. Then we have a simultaneous contribution of money equal to the contributing partner's share of the debt. That difference reduces the partner's outside basis and could, if it would take the outside basis below zero, would result in a gain under 731. We're going to talk about 731 later on. But that's the issue. That's the key issue, is whether the contributing partner recognizes gain through the effect of this liability, basically the liability shifting that goes on. And one other thing we might add there is if the contributing partner does recognize gain, because there's a distribution of deemed distribution of money in excess of outside basis, then there may be inside basis adjustments under 734B. So you're getting a little ahead of ourselves, but you should always, again, in terms of issue spotting, if you have a distributee partner recognize gain or loss, then if there's a 754 election in effect, there's going to be 734B adjustments that are going to happen as well. So that's a contributions of encumbered property. Any questions thus far on anything I've talked about?
Yeah, you talked about the difference between the capital account and the outside basis account. Are you going to talk about the tax account too? I'm confused about that one.
Yeah. So I'm going to talk about that when we get to 704C, the tax capital accounts. So there is another account that we brought up later in the course, the tax capital account. So bracket that off for now. We'll come back to it. Any other questions at this point? Okay, the next topic we discussed is allocations. Again, allocations of tax items. Partnership recognizes gain or loss or deduction or income. Generally, those items, they'll be allocated to the partners in some way, shape, or form. And then the partners will report those items on their own tax returns. So before we get to the big question, of course, which we spent a lot of time on, is how do we make allocations among the partners? Who gets what? Before we get that, there's just a couple of technical things we can go over quickly. We talked about separately stated versus non-separately stated items. And the idea here is that because characters determine at the partnership level, if we have a unique character of an item, like long-term capital gain, we will characterize that item at the partnership level and then flow it through, allocate it with that character. So the partner will recognize long-term capital gain equal to their share of that item. But if we just have what I've called plain vanilla ordinary income, ordinary deduction, we can crunch that all together and just smash it all together into one bottom line amount because there's no nuance. It's just ordinary income or ordinary loss. And so that's what we call non-separately stated or non-separately stated gain or loss. Another thing we have to think about is 704D. Generally, if you get allocated an item of loss or deduction, you claim that loss or deduction on your own tax return. But there's one limit. 704D says if you don't have enough outside basis to absorb that loss or deduction, then that loss or deduction is suspended. The excess loss or deduction is suspended and carried forward to the next year, where it's treated as a loss the next year, subject to the same limitation. So again, tax items flow through on the last day of the year, 12/31 of the year. And if you have a net loss that flows through, you have to see whether you have an outside basis to support claiming the loss now or whether they get trapped. Now, frankly, 704D doesn't come up all that often in the partnership context, mostly because of Section 752. You're getting outside basis credit for your share of the debt. And those rules we learned are designed to really be taxpayer friendly and to give the outside basis to the partner who's most likely to need it. And so you don't typically see 704D as a major issue in the partnership context. In S corps, where you don't have a subject to corollary, the 704D rule, which is not 704D, it's 1366D, is much more commonly triggered, but not really so much in the partnership context. If you think about it, because you're getting your share of the partnership debt, the only way you would get it would be if partnership losses that get allocated to you were funded by another partner's contributions. It's quite rare. Usually they're funded by debt. And again, you're getting share of the debt. Okay, so those are two technical rules, but then we get into the sort of the major rules of, okay, how do we allocate items among the partners? And we said under 704, 704A says, look to the partnership agreement, which is deceptively simple, right? Because then 704B comes in and says, well, allocate in accordance with PIP, partner's interest in the partnership, if the allocations under the partnership agreement lack substantial economic effect. So the other way to say this is we're going to look to the partnership agreement and we're going to test the allocations for substantial economic effect. So the partnership agreement will say how items are allocated, and we test those for substantial economic effect. If they have substantial economic effect, then they're respected and they go where the partnership agreement says they go. Substantial economic effect, we know, can be broken down into two components: economic effect and substantiality. And economic effect is much more sort of mechanical. We know the general test, the big three, is satisfied: maintain capital accounts, liquidate according to positive capital account balances, and if any partner's capital account is negative on liquidation, that partner has to restore the deficit balance. That's the general test. If you meet those, and those are just the partnership agreement, you can look at the partnership agreement and figure out those. There's no real analysis. Then it has economic effect and you move to substantiality. If we talked about, though, how the third prong of that test, the big three, is often not satisfactory to the partners in terms of their business deal. That particularly limited partners are going to be loath to sign something that puts them on the hook for negative capital accounts. So Treasury created this alternate test. The alternate test says if you meet the first two of the big three and the partnership agreement has this qualified income offset, QIO, then your allocations have economic effect to the extent the allocations don't drive your capital account below zero, or if you have a limited deficit restoration obligation below your LDRO amount. So the analysis there is, again, you can look at the agreement and see whether the first two of the big three is there, whether there's a QIO. The analysis then is, does the allocation that we're testing, does it drive you below zero? If the answer is no, then the allocation is valid. If the answer is yes, it does drive you below zero, then you have to see whether the partner has a limited deficit restoration obligation, LDRO. If the LDRO is enough to cover the entire allocation, the entire negative capital account balance, then the allocation has economic effect. It's valid, I guess. I shouldn't say valid, it's then you move on to substantiality. If the allocation, if the negative capital account is not supported by an LDRO, then to that extent, it doesn't have economic effect and it gets reallocated under partner's interest in the partnership, under PIP. What's an LDRO? We talked about this, that there's some things that are pretty obviously an LDRO, like an obligation to restore deficit balances, capital account balances up to X dollars. It's not the third of the big three, because the third of the big three, it has to be unlimited. But if it's explicitly limited, then you have an LDRO equal to that amount. If you have to contribute capital in the future to the partnership, that's an LDRO equal to the amount you have to contribute in the future. And perhaps most subtle, if you contribute a promissory note, your own promissory note, that's treated as an LDRO as well, because you're going to be kicking it in no later than the liquidation of your interest. Okay, any questions on that under the alternate test? Well, we got a couple of complications. Again, it's hard to talk about these in the abstract. We did problems, but generally, one of the things that we talked about is where you have to anticipate future distributions and seeing how low you can go, right? That's really the idea, is how low can your capital account go? In determining whether your capital account would go too low, we pull forward future distributions that are reasonably expected to be made that are not matched by capital account increases. So for example, if we expect to borrow money, the partnership expects to borrow money in the future and then distribute that money, that's going to be a distribution you'll have to anticipate and bring forward for purpose of seeing how low you can go. The analogy I made in class was like, if you know that your rent comes out of your bank account every month on January 1, and you want to know how much you can spend, you can withdraw from your bank account on December 31, on the 31st day of the prior month, you're going to treat your bank account as having an amount equal to the amount less the rent that's going to come out the next day, right? So we're going to keep a cushion in your bank account so that you don't overdraw on the first of the month. Or we're going to keep an amount in the capital account so that we don't result in a impermissible capital account deficit when this expected distribution happens, right? And then closely related to that concept is this QIO, this qualified income offset, that we have to have in the agreement. And the qualified income offset says, well, if we have a distribution that takes us too low that we didn't anticipate, because we're human beings, we don't know what's going to happen in the future, so we didn't anticipate it. Therefore, our capital account got too low. A QIO says we're going to allocate, once we get in that situation, we're going to allocate items of income off the top to the partner with the too low capital account as quickly as possible to get that capital account back up to zero, assuming there's no LDRO. That's the QIO.
Question about the QIO.
Yeah, John.
So I was looking through notes, and if you allow some income to one partner, do you have to do like allocate this equal amount of deductions to the other partner? Is that how that works?
Well, so that gets to the question, if there's enough net income, so let's say your capital account is negative 100 because we had this distribution and it's not supposed to go below zero. And let's say we have 100 of net income this year. We would just give you the 100 of net income. So it should all go to you. But let's say we don't have 100 of net income. Let's say we have 100 of gross income and 100 of deductions. Well, in that case, we have zero net income. So the QIO would then say, if we have to, we can even allocate gross income to you. So in that case, we'd give you the 100 of gross income, and then we give the other partners the 100 of deductions. So it's not quite, we don't give a deduction, but the effect of that, if we give a gross income allocation, is going to be to give deductions to the other partners. It's a little bit maybe far beyond where we went, but not too far. Again, we did a problems on this. Yeah, maybe it's saying too much, right? The problems are going to look like problems we've done in class. This class is hard enough. I don't really need to create some fancy fact pattern. Be comfortable with what we did in class, understand what's going on in those problems. Don't just sort of memorize or, try to deeply understand it. But again, there are no surprises here. I would be very surprised if anyone was surprised at what is on the exam. Okay, so that's that. The next topic, well, let me just talk about PIP, partner's interest in the partnership. If we lack economic effect, then we have to allocate or reallocate under PIP. And we have this special PIP rule. It goes hand in hand with the alternate economic effect test. Whereas if you have an allocation that lacks economic effect on the alternate test because it would drive you too low, that portion that would take you too low, the portion that would be the negative capital account, ends up being reallocated under PIP. And PIP is a facts and circumstances test generally, but we have some special rules, and one of them applies here. We call this the Special Pip Rule, -1B3, 3 little i's, 1.704-1B3, 3 little i's, and it says, okay, if you have an economic effect failure, you can determine where the allocation goes by comparing two hypothetical liquidations, both at book value. So you would liquidate for book value at the end of the prior year and see where the cash goes, and liquidate for book value at the end of the current year and see where the cash goes. And by comparing those two outcomes, you can see where the missing allocation goes. We did that several times. And again, there's a good set of examples here. This is the regulation examples, 1.704-1B5. Example 1 had like 10 subparts that all, well, many of them involved the ultimate effect test and some with this PIP rule. The next thing we talked about is the substantiality test. So once you have economic effect, it has to be substantial. One thing to keep in mind with substantiality, again, we're worried here about offsetting allocations and people sort of arbitraging there are different tax attributes. So one thing to keep in mind is, in order for me to set up a substantiality problem, you're going to have to know stuff about the partner's own tax attributes, because it's all about the interaction of the allocations with the partner's tax attributes. So in terms of a hint, if you see a problem getting into the partner's own tax attributes, like, partner's in a low bracket or a high bracket, or has a capital loss carry forwards or something like that, then there's going to, because I'm not tricking you, then there's some substantiality issue going on there. If I don't give you that information, then you can't apply these tests, and therefore substantiality is not going to be something that I'm looking for. And with substantiality, again, we have the 3 tests that are really 2, because only 2 will apply on any sort of given fact pattern. And we're looking in the overall tax effects test, or the after-tax effects test, people call it different things. We're looking to see whether any partner, as a result of a special allocation regime, could be substantially worse off. So in that case, we're going to have to sort of see some range of possibilities that exist and see whether there is a possibility that partner could be worse off. If so, then that test is passed. One of the example questions I gave is a substantiality question. So we'll go over one on Wednesday. The other tests are shifting and transitory, and they're really the same focus. And they're asking the question of will the capital accounts end up in about the same place as under the base case? And do the partner's tax liability in the aggregate go down? If the answer to both of those questions is yes, then those tests are failed. And shifting is looking at a 1 year, everything happens within 1 year, the offsetting, and transitory is where the offsetting stuff happens over a period of years, more than 1 year. And you have to sort of pass them all in order for substantiality to be passed. And again, if you're dealing with intra-year offsetting, then it's just going to be overall tax effects and shifting. If you're dealing with multi-year offsetting possibility, then you're going to apply overall tax effects tests and transitory. Okay, any questions on substantiality? And that's just, remember, that's the game that tax lawyers could easily play. They still can play it. You just have to add some risk, but without a substantiality test, they could just play this game of offsetting allocations and give preferred types of income to certain taxpayers and give others to others. And again, they'll just exploit their differences in tax attributes to their collective benefit at the expense of the fisc. It's just basically selling, the strategy that's trying to deal with is people effectively trying to sell their tax attributes. The tax law doesn't let you do that. If you have net operating losses, you can't sell them to somebody that says, hey, I got a bunch of income. I'd love to use those NOLs. I'll pay good money for them. We don't let you do that outside the partnership world, and we don't let you do that effectively inside the partnership world. Substantiality is what's designed to sort of impede that. Okay, any questions on substantiality? Okay, the next topic we dealt with is, the jargon-filled issue with non-recourse deductions. And here, again, we're getting with situations where the deductions are not economically borne by either of the partners because they're borne by the lender because the debt is non-recourse. And so non-recourse deductions can't have economic effect. And so when we have non-recourse deductions, there's a different safe harbor we apply. We called it the -2E safe harbor, 1.704-2E safe harbor. So when you have non-recourse deductions, you don't apply substantial economic effect safe harbor, you apply the -2E safe harbor. And the trick there is, well, what are non-recourse deductions? Right? Because you have to identify them to know that you apply a different safe harbor. And non-recourse deductions exist generally when the partnership minimum gain goes up during the year. So again, let's think about issue spotting. If you see a fact pattern with non-recourse debt, that is where you have to keep track of the partnership minimum gain. What is partnership minimum gain? It's effectively the amount by which the non-recourse debt exceeds the book value of the property that secures the non-recourse debt. And usually in the early years, there won't be minimum gain because you're eating through the sort of equity layer. But then eventually, due to depreciation, the book value drops below the level of debt, and there you do have minimum gain. So when your minimum gain goes up, your partnership minimum gain goes up, that indicates that you have non-recourse deductions. It's generally the depreciation on that property that secures a non-recourse debt. And those are non-recourse deductions, again, tested under -2E. And the partnership agreement can specially allocate non-recourse deductions. So we saw a fact pattern where the partnership agreement said we're going to allocate things in a certain way, but then non-recourse deductions are allocated in a special way. And as long as that meets the safe harbor, then that's valid. And then the sort of the cousin of your non-recourse deductions, your minimum gain chargeback, which says that if your partnership minimum gain goes down, remember, if your partnership minimum gain goes up, that indicates non-recourse deductions. If your partnership minimum gain goes down, that typically triggers the minimum gain chargeback rule, which means you're going to charge back gain to the partners in the same proportions as their share of the non-recourse deductions. So you're going to charge them back in the same way that you gave the non-recourse deductions in the first place. So those are non-recourse deductions and minimum gain chargeback. Those sort of go together. We did a problem on those. Again, when I tested on that, I haven't been very creative, and I've used, what looks to be like a pretty similar problem.
Can I ask a question?
Yeah.
Can you tell me a couple of scenarios where the minimum gain chargeback is triggered? Like one of them is sale of the property.
Mm-hmm.
There might be another one that I'm not thinking of.
So if you sell a property that secures a non-recourse debt, then the minimum gain is zero, right? Because your debt is zero and the book value is zero, it's gone. So that your minimum gain would go down. If you pay off the debt, pay down the debt. So let's say you earn a bunch of income and use the cash to pay down the debt. That could cause your minimum gain to go down. You could have the creditor cancel a portion of the debt. So like a workout. So again, let's say the property has a book value of 800. The debt is 1,000. Well, at that point you have 200 minimum gain. But let's say the lender says, because let's say the property is only worth 500, right? The book value is 800, but the property could be worth 500. The lender says, okay, I'll reduce the debt from 1,000 to 500 because I don't want you to walk away from this property, and I'd rather you keep paying on the debt, at least the 500 portion. And so now you go from having 200 minimum gain to having zero minimum gain, because again, the book value is 800, the debt is 500. So those would be the three common situations. Selling of the property.
What account are we dealing with when we work these non-recourse deduction problems?
Yeah, book. Minimum gain is a book concept. Minimum gain is where there's a book tax difference. Now, we didn't do too much of where we had non-recourse deductions in 704C in the same problem, in the same situation, so we didn't have to deal with that very much, but I know we did at least once. And so where those two differ, you use book, not tax. And the regs say that. I don't remember off the top of my head exactly where, but they do definitely say that where book and tax are different, you use book value for calculating minimum gain. Okay, the next topic we discussed is another allocation issue, again, sort of a special issue, and that's 704C property. So again, we have a situation where you have property that has a book value different than its tax basis, a book tax disparity. And we also introduced this concept of a tax capital account for the partners. And the way I think about the tax capital account is it's an account that helps you keep track of the 704C issues. And it's just calculated just like your book capital account, except you're going to, instead of increasing your capital account by your tax capital account by the fair market value of property contributed, you're going to increase your tax capital account by the tax basis of the property contributed. And instead of increasing your book capital account by your share of book income, you're going to increase your tax capital account by your share of tax income. So it's like the same account, but we're going to use the tax concepts instead of the book concepts. And again, we only really need it for 704C properties. There's no book tax disparity. then the book capital account and the tax capital account would be the same. There's no need to keep track of it. But where it's different, we keep these different. And in some cases, it'll look like the outside basis. But remember, not always, because outside basis includes your share of the debt. Capital accounts do not. Outside basis can't go below zero. Capital accounts can. So for those reasons, tax lawyers keep track of the tax capital account to see the 704C issues clearly. But the gist of 704C is just going to be when we have a book tax disparity, we have to make allocations in accordance with 704C principles. And the code requires us to do that. So a partnership agreement will say, here's how you allocate tax items, but it'll always say like except as 704C requires. So it's a limitation on your electiveness. Generally allocations are elective. 704C says, no, you're going to allocate this way. So what are these allocations? Again, if you have property that was contributed with a fair market value different than tax basis, then upon the disposition of that property, you're going to have to make 704C allocations. If it's depreciable property, then you're going to have to make 704C allocations during the holding period of the property, because you'll have depreciation that's going to be different for book and for tax. And we talked about the methods. There are 3 methods. They all start the same. Calculate your book and tax items. Again, that's going to be gain or loss on disposition of the 704C property. It's going to be depreciation, annual depreciation if it's depreciable property. Right? Land is not depreciable. Buildings, equipment, machinery are. So calculate your book and tax items, allocate the book items according to the partnership agreement. It's going to tell you how you allocate things. Then you're going to give the non-contributing partners tax items equal to their book items. But the ceiling rule says you can't give them more tax items than the partnership has. And if you use a traditional method, you just stop there. If you use curative or remedial, then you're going to offset the impact of the ceiling rule. You're going to sort of make the non-contributing partners whole by either curing with other tax items of the same character, sort of 2 wrongs make a right, or with remedial, just making them up out of whole cloth. And again, I would just, if I'm in your shoes, the curveball of all of that is just with remedial. If you see a fact pattern that involves remedial allocations and it involves depreciable property, the calculations of book depreciation is a little bit weird, counterintuitive. Generally, book depreciation is the same rate as tax. So again, I'll give you the remaining recovery period and everything will be straight line. So generally, we'll just depreciate the book value over the remaining recovery period. So if there's 10 years left, you get 1/10 of the book value each year. You get 1/10 of the tax basis each year for tax. But for remedial, we have a special book depreciation calculation where we break up the book basis in two parts, recover the one part over the remaining recovery period, recover the other part over sort of a new recovery period. So again, abstract, I can't explain it better than that here in 3 minutes, but we did problems. That's another situation where just work some problems, work some fact patterns. Once you do it a few times, it's pretty straightforward. Okay, any questions on 704C? Definitely will be 704C on the exam. I mean, no doubt about it. We spent a lot of time on it. It comes up all the time in practice. It's not something that non-tax lawyers are going to be able to understand. So it's important for you to understand that it's not all that complicated.
Can you tell me, like, there's part of this analysis where we assess, who's winning earlier on in the period, and then who wins later on. How can you elaborate a little bit on that?
Right. I mean, we actually have a problem. So one of the one of the sample questions is going to be just like that. But but generally, because this is all like who gets the tax depreciation and when. That generally the partners are going to want to get the tax depreciation. So partners are going to want to get more tax depreciation. It reduces their tax burden now. And now it's going to even out eventually, at least in theory, leaving aside like stepped up basis and all that, death, it'll even out down the road. But again, most tax people, they'll want tax depreciation now. They'll want less income now. And so that's sort of the strategy. So you're going to want your client to get tax deductions earlier rather than later, and vice versa, realize income later rather than earlier.
Okay, so don't we give the non-contributing partner most of the tax depreciation when the ceiling rule applies?
What we give them, the ceiling rule applies, we're not going to give them their full share of tax depreciation. We're going to give them less than if the ceiling rule didn't apply. And then the curative offsets the ceiling rule. The remedial does as well. And so that's really what's going on. And because of the weird book depreciation, it's not always, there's no hard and fast rule about which one's best. We talked about this in class. Again, problem 1 in the sample questions really hits this hard. So maybe we defer to that. But the bottom line is you basically want to sort of sketch out and see what's going to happen, because it's not intuitive or easy to intuit who wins and who loses under these methods, what's best and what's worse. So you have to sort of plan it out, game it out. Okay, I'll just also talk about reverse 704C. So when you have a new partner is going to come in, you have existing partnership, and a new partner is going to come in by contributing cash or property to this partnership and get back a partnership interest. That is an event that is a permissible book up revaluation event. Same thing, book up, revaluation, those are interchangeable terms. And what that means is we're going to take the existing property and we're going to book it up to fair market value right before the new partner comes in. We book up that property, we allocate the resulting book gain to the existing partners, and then the new partner is then admitted. Again, we did a problem, at least one problem exactly like this. And what that does is that creates what's known as reverse 704C issues, because now again, we have a book tax disparity. The existing property on the books, the book value went up because it was booked up. The tax basis didn't go up. There's no tax consequence on a book up. So we created a book tax disparity that wasn't there before. But the same idea happens. It's reverse 704C. And what ends up happening is that the existing property is effectively treated as being contributed by the existing partners to a new partnership. And so when that existing property is sold, then we're going to have to allocate that gain, those gains, in accordance with 704C. The next topic we talked about was sale of a partnership interest. Again, a very common fact pattern. Someone's selling a partnership interest, a sale across. And we keep that straight. What we just talked about a second ago with reverse, we didn't have a partners selling interest to one another. We had a partnership issuing a new partnership interest. That's not a sale across. That's a contribution of property to the partnership. Here we have a sale across. A partner is selling her interest to a new partner. And the sale across just triggers issues for the seller, namely what's the character of that gain or loss. We talked about how you calculate the overall gain or loss. And then you look at 751A if the partnership has hot assets, and you allocate hot asset gain or loss to that partner, to the seller, and then whatever's left is capital. And from the buyer's perspective, it's really, well, let me just also add, just for the seller, don't forget that if the sellers had a share of the partnership debt under 752, then that share of the partnership debt is included in that seller's amount realized under 752D. So again, her outside basis includes amount of debt. The amount realized is going to include that same amount of debt. 752D. I just point that out to kind of get sort of something easy to sort of miss. The buyer is going to take an outside basis equal to her cost basis. And then if she gets a share of the debt, which typically will happen, if she's stepping in the shoes of the seller, whatever the seller's share of the debt will now be the buyer's share of the debt. That increases her outside basis. But the real interesting thing is going to be, what about the share of the inside basis? And under 743A, we don't adjust the inside basis. But under 743B, if there's a 754 election in effect, then we give the buyer special basis adjustments that will effectively step up her share of the inside basis to reflect the fact that she's paying cash for that she's basically bought into that gain. And we did problems with that SBA. If that happens, I'll give you what the fair market values of properties are, right? So the valuation will be pretty clear, but just also know that if the stated assets are less than the implied purchase price, that the excess is goodwill, right? So if somebody's paying a premium, again, an amount above and beyond what the stated assets on the partnership would imply, that excess is going to be goodwill, which is going to receive a special basis adjustment in goodwill that then the buying partner can amortize over 15 years. It's a 197 intangible. We did a problem just like that where the implied goodwill was 30, I believe. The buyer was buying a 1/3 interest, so the buyer is paying a premium of 10. So that's a sale of partnership. Again, very common fact pattern, happens all the time. It's actually the easiest stuff we've done. Not to say it's easy, but it's pretty easy. And so you should definitely be comfortable with how sales of partnership interests are taxed. And then the last major topic we covered was distributions. And since we just went over this, I'll hit this pretty fast. But with distributions, we have several issues. Again, sort of a checklist issue. Do we have gain or loss with distributee? The distributee is receiving stuff. Do they have gain or loss? And on the gain side, the answer is no, unless the distributee receives cash in excess of her outside basis. For loss, the answer is no, unless the distributee is liquidating her interest and receives only cash. There's some other other situations where it should have a loss that we talked about, but I won't hold you responsible for. So generally no gain or loss recognized, with some very narrow exceptions. The next question is, if the distributee receives basis of property, receives property, what's her basis in that property? She receives cash. We know what the basis of cash is. What if she receives property? Well, the 732 rules tell us how to determine the distributee's basis in property distributed. And in part, it's going to depend on, is it a liquidating distribution or a non-liquidating distribution? And then 733 then says, what's the effect on the distributee's outside basis? And generally, it's going to be reduced by the amount of money received or the basis she got for the distributed property. And then those are the general rules. And then we talked about some important exceptions. And this is the way I think about it. Those are the rules, but you got to make sure the exceptions don't apply, because the exceptions apply. Now you got other things to worry about. And we focused on two sets of exceptions. One is this disguised sale rule, 707A2 Cap B. And you're really looking there for contributions of property and then distributions of cash within 2 years. Because then the presumption applies, it's presumed to be a disguised sale. And in that case, you're just going to treat the property as being sold in whole or in part for the cash received, instead of it being a straight contribution and distribution. And the second set of exceptions are the mixing bowl rules. And again, you're looking at contributed property. Somebody contributes property to a partnership, and then within 7 years, that contributed property is distributed to another partner, or the contributor receives a distribution of property, not cash, but property. And if either of those things happen, again, that 7-year magic window, then you end up having to recharacterize the transaction as we discussed, as those two rules apply, 704C1 Cap B and 737 are the mixing bowl rules. The last thing I'll say on distributions is just what about the book consequences? At a minimum, you're going to need to book up, again, if the problem asks you to do so, but you need to book up or book down the distributed property to fair market value. And then you reduce the distributee's capital account by that fair market value. Any questions on distributions? So again, when I look at this, you basically have, the way I think about it is contributions of encumbered property is a big issue. We've talked about allocations. We can break that up into sort of 3. We've got sort of the substantial economic effect test. We've got non-recourse deduction and minimum gain chargeback. We've got 704C. So now I basically got 4 topics I've talked about. Contribution of encumbered property and the 3 sets of allocation issues. That's 4. Then you got sale of partnership interest. That's seller and buyer. That's 5. And then you got these distribution rules, 6. So I think of there's basically 6 topics. Now, some issues we covered ripple through a bunch of this stuff, like 752, right? Arises in different contexts. So that can ripple through. But in terms of just sort of, I would expect that problems will be, that most if not all the points on the exam will come from those 6 issues, some fact patterns involving those 6 issues. So just to give you an idea of how, even though we've covered so much in this class, still, we still kept hitting sort of the same fact patterns, same issues. And there's a lot of things that can go on in these fact patterns, which again make them good exam questions. I don't have to write a very long, complicated question. I don't write long, complicated questions and still have, enough analysis for me to evaluate you, which is basically my goal, right? Is to evaluate your knowledge of this stuff. Okay, any questions on any of that? So again, my advice, keep doing the problems, do the problems. The book has problems in its explanation. We did problems in class. There are problems in the regs. And if you keep hitting those problems and getting really comfortable with all that stuff, that would be my advice in terms of attacking this class. Okay, no questions? Okay, so I'll see everybody on Wednesday. So I'm going to give you 15 minutes early. So again, I don't implore you, I ask you nicely to go to the evals, if you will, on My Georgia Law. And I'll see everybody on Wednesday. Bye-bye.